Okay, investors, today I'm going to be discussing, as promised, the rights issue, a rather common event in these trying times. There are two reasons, basically, for companies to do a rights issue. Number one, they need a bailout from their shareholders because they ran out of cash. Or number two, they just grew a little bit too fast and now they need to recapitalize the business. Okay, so this is how the basic process works. Companies, and I'm talking here an example of the first one, Esau Frankie. You can see it has a situation as a construction company where its debt levels start to rise. It gets to a position where the bankers are not that comfortable with its credit exposures, and they say to them, listen, we need you to go out and increase the base of cash that's available so that you can retire your funding facilities and come on to the market with a more coherent balance sheet. So this is how the process works. A company like that appoints an underwriter, somebody who's going to take all of the shares if the shareholders of the company refuse to take them themselves. The process is announced, a circular is distributed, and what you will find is that there are things called N shares which will pop into your account, and they'll be traded there for roughly 3 weeks. Okay, so you get the N shares, and the N shares effectively are rights. They are what they call non-paid letters or nil-paid letters. They are letters of allocation. You receive them if you are a shareholder, and basically what they are is the right to take up the offer at the price at which the shares are offered. Normally shares like this would be offered at a discount to the prevailing value of the shares. In a case like Esau Frankie, they announced that they were doing a rights issue at R2.15, which it turned out ended up being above the price at which the shares were trading. In that case, nobody has any real incentive to follow their rights, and the N shares therefore trade at zero value in the market. In a case where the shares are offered at a discount to the market, which is a case that we saw recently with a company like Capitec, this is an example of a company that has grown very fast, is doing well, people love it. They need more cash because in terms of their balance sheet, they see the need to take the company forward and they feel that shareholders are likely to follow those rights. So in that case, a rights issue is pitched at 125 Rand, which is at a sizable discount to where the share is trading. In that instance, everybody wants to follow their rights. Everybody wants to get in there and get a little bit more of the action because they're being offered shares at a discount. In that event, the N shares will trade in your account at a positive value. In other words, a price where the N share represents the value gap between the discount price at which you're being offered the shares and the price at which they trade in the market. Okay, when you have a rights issue, there are three things you can do. The one option is to say to your broker, yes, I want to follow my rights, in which case what will happen is that they will take the money out of your account at the offer price, depending on the terms of the offer, and that will then be coming back to you in the form of these new shares. The second option you have is during the period when the N shares are trading, you have the right to go into the market and sell those N shares, get them out and cash in, effectively taking off the table the discount value that is being offered in the rights issue. And effectively what's happening then is that someone else is acquiring your N shares and they're going to follow their rights. So I guess the situation to hold in your mind here is that if you want to get more of the said share, say if you wanted more Capitec shares, you would be saying, yes, I want to follow my rights. You have to then cough up the money, but you do get the discount. The alternative is you sell out the shares, someone else takes them over, and you effectively taking some money off the table, and you are left with your original quantity of shares, and that's that. The third thing you can do, which regrettably a lot of people do, is do nothing, which is idiotic, because if you do nothing in a case like this, where a real discount is being offered, the N shares expire valueless, and you've basically left money on the table. You've basically torn up banknotes and moved away from the thing. So it's very important when you see either N shares in your portfolio when you log on online, or secondly, when you receive a notice in the post from companies indicating that there's going to be a rights issue, is that you carefully look and see what's going on. You contact your broker back and you indicate whether you A, want to follow your rights, or you B, want to sell out the N shares. In this case then, obviously, we have a company that is taking advantage of capital raising opportunities and moving into the market and growing, and that would be a net positive. So look out for it. We'll see many rights issues in the future, and you can rest assured that this one is going to be back for more.